Let me ask you something. When was the last time you checked your portfolio and felt completely calm about it? Not nervous, not excited, not wondering if you should sell everything and sit on cash until things settle down, just calm. If you're like most people, the answer is never, and that's exactly the problem. Because here's what happened in 2024. The market went up. The Dalbar study came out, like it does every year, analyzing how actual investors perform compared to the market itself. And once again, investors proved they are their own worst enemies. The guess-right ratio, which tracks how often investors correctly time their money moving in and out of the market, hit a record low of 25%. Let me repeat that. Investors guessed right on market direction just 1/4 of the time. That ties the worst performance ever recorded. You know what that means? If you flipped a coin, you'd have better odds than the average investor trying to time the market. A coin flip gives you 50-50. These people managed 25%. That's not just bad. That's spectacularly, statistically, impressively bad. And yet, every single day, millions of people wake up, check the news, see some headline about tariffs or inflation or elections or AI taking over the world, and they make a decision. They decide today is the day to get out, or today's the day to get in, and they're wrong. 3 out of 4 times, they're dead wrong. So here's the uncomfortable truth nobody wants to hear. You're not going to beat the market by being smarter than everyone else. You're not going to time the top and the bottom. You're not going to outsmart Wall Street or predict the next crash or ride the wave perfectly. Because the data is crystal clear. The more you try to be clever, the worse you do. The solution? It's boring, it's systematic, it's automatic, and it works. It's called dollar cost averaging. And if you're not doing it, you're leaving money on the table. Dollar cost averaging is stupidly simple. You invest the same amount of money at regular intervals, no matter what the market is doing. Every month, $500 goes into your index fund. Market up, $500. Market down, $500. Market sideways? You guessed it. $500. No decisions, no guessing, no checking CNBC to see if Jim Cramer thinks it's time to buy. Just automatic, disciplined, boring investing. And that's exactly why it works. Because here's what most people do instead. They wait. They see the market climbing, and they think, I'll wait for a pullback. Then the market climbs some more, and they think, okay, now it's definitely too high. I'll wait for the crash, and the market keeps climbing. And by the time they finally give in and buy, they're buying at the top. Right before the crash they were so afraid of actually happens. Then what do? They panic. They sell at the bottom because it feels safer to have cash when everything is falling apart. Except now they've locked in their losses. They bought high and sold low. Congratulations. You just did the exact opposite of what you're supposed to do. And then, to add insult to injury, they sit on the sidelines in cash while the market recovers. Because now they're scared. They got burned. They don't trust it. And by the time they feel confident enough to get back in, the market's already recovered. They missed the rebound. They missed the best days. Which brings me to the most important thing you need to understand about investing. Missing the best days destroys your returns. Let's look at the data. If you invested in the S&P 500 and stayed invested the whole time, your long-term average annual return is about 10%. Pretty good. That's how wealth is built. But here's what happens if you miss the 10 best days. Not 10 years, 10 days. Your return gets cut by more than half. Instead of 10%, you're looking at something like 4 or 5%. Miss the 20 best days? You're barely beating inflation. Miss the 30 best days? You're in the red. You would have been better off stuffing cash under your mattress. And here's the kicker. Those best days, they happen when things feel the worst. March 24th, 2020. COVID panic was at its absolute peak. The world was shutting down. People were terrified. The market had been crashing for weeks, and on that one day, the S&P 500 jumped 9.4%. In one day. If you sold out of fear before that day, you missed one of the biggest single-day gains in history, and you probably didn't get back in for months. Or look at the 10 best days in the market's entire modern history. Want to know when they happened? 100% of them occurred during the Great Financial Crisis of 2008 and the COVID crash of 2020. Every single one. The best days happened during the worst time. They cluster together with the worst days. You can't have one without the other. So when people say, I'll just get out when things get bad and get back in when things calm down, they're lying to themselves. You can't time it. Nobody can. The data proves it. Vanguard did a study comparing lump sum investing to dollar cost averaging. They found that investing a windfall all at once beats systematic investing 2/3 of the time. Mathematically, lump sum wins. But here's the thing, that's only true if you actually do it. And most people don't. Because most people freeze when they have a big chunk of cash sitting there. They overthink it. They wait for the perfect moment. And they never pull the trigger. Dollar cost averaging wins on behavior. It removes the decision. You don't have to be brave. You don't have to time anything. You just do it, month after month, through crashes, through rallies, through boring sideways markets. You keep going, and in extreme markets, when fear is at its highest, dollar-cost averaging can actually outperform. A study on crypto investing, which is way more volatile than stocks, found that dollar-cost averaging during periods of extreme fear returned 1,145% over 7 years. Compare that to a simple buy-and-hold strategy, which returned 1,046%. The systematic approach beat buy-and-hold by 99 percentage points. Why? Because it forced investors to keep buying when prices were at their lowest, when fear was at its peak, when everyone else was running for the exits. That's the power of discipline. You don't have to be smart. You don't have to predict anything. You just have to keep going when everyone else quits. Now, I'm not your financial advisor, and this isn't me telling you what to do with your money, but if you're sitting on the sidelines trying to figure out the perfect time to invest, you're already losing. The perfect time was yesterday. The second best time is now, and the way you do it is systematically, automatically, without thinking about it. Because the market doesn't reward the people who are the smartest, it rewards the people who stay in the game. Let me tell you what happens when you don't have a system. You check the news, you see headlines, tariffs, inflation, recession fears, election uncertainty, and you make a decision based on how you feel in that moment. Fear kicks in, you sell, or greed kicks in, you buy. Either way, you're reacting emotionally. And emotional decisions are almost always wrong. The Dalbar study has been tracking this for decades. Every single year, they find the same thing. The average equity fund investor earns several percentage points less than the market itself, not because they're picking bad funds, but because they're making bad timing decisions. They're buying when they feel confident and selling when they feel scared. And those feelings are almost always wrong. Think about it. When do you feel confident about the market? When it's been going up for months? When everyone's talking about how great stocks are? When your neighbor's cousin's friend just made a killing on some tech stock? That's when you feel good about investing. But that's also when prices are high. You're buying expensive. And when do you feel scared? When the market's been falling. When the news is all doom and gloom. When everyone's predicting the next Great Depression. That's when you want to sell. But that's also when prices are low. You're selling cheap. So you end up buying high and selling low. The exact opposite of what you're supposed to do. And you wonder why your returns suck. Dollar cost averaging fixes this. Because it doesn't care how you feel. It doesn't care what the headlines say. It doesn't care if you're scared or confident. It just executes. Same amount, same schedule, every time. When the market's up, you buy fewer shares at a higher price. When the market's down, you buy more shares at a lower price. Over time, you average out the cost, you smooth out the volatility, and you keep accumulating shares regardless of what's happening in the short term. And here's the beautiful part. You don't have to watch the market. You don't have to stress about it. You don't have to make decisions. You set it up once, automate it, and let it run. Your money goes from your paycheck to your brokerage account to your index fund without you lifting a finger. No willpower required, no discipline required. It just happens. Because let's be real, most people don't have the discipline to invest consistently on their own. Life gets in the way. Bills come up. Emergencies happen. And when you have to manually transfer money every month, it's easy to skip it. Oh, I'll do it next month. Next month turns into 3 months. 3 months turns into a year. And you've lost a year of compound growth. But when it's automatic, it doesn't matter. The money moves whether you remember or not. Whether you feel like it or not. Whether the market's up or down. It just happens. And that consistency is what builds wealth. Let me give you some real numbers. Let's say you invest $500 a month into an S&P 500 index fund. Over 30 years, assuming the historical average return of 10%, you'd have just over $1 million. $1 million from $500 a month. That's the power of time and compounding. But here's what happens if you try to time it. Let's say you're like the average investor in the Dalbar study. You guess wrong 75% of the time. You panic sell during crashes. You sit on the sidelines during recoveries. You miss the best days. Your return drops from 10% to maybe 6%. Over 30 years, instead of $1 million, you end up with about $600,000. You just cost yourself $400,000 by trying to be clever. $400,000. That's a house. That's early retirement. That's your kid's college paid for. Gone. Because you thought you could outsmart the market. Now, I'm not saying dollar cost averaging is perfect. It's not. There are downsides. If you have a lump sum sitting in cash and the market goes up, you would have been better off investing it all at once. Mathematically, that's true. But here's the thing. How many people actually have a lump sum just sitting there? And of the people who do, how many have the guts to dump it all into the market in one shot? Most people don't. They hesitate. They wait. They try to time it. And by the time they finally invest, they've missed months or years of gains. So while lump sum investing might be mathematically optimal, dollar cost averaging is behaviorally optimal. And behavior is what matters. Because investing isn't just about math, it's about psychology. It's about managing your emotions. It's about not freaking out when the market drops 20% in a month. It's about staying the course when everyone else is panicking. And that's where systematic investing gives you an edge. It removes the emotion. It removes the decision-making. It removes the temptation to try to time things. You're on autopilot, and autopilot works. Here's another thing people don't talk about. Bear markets are where dollar-cost averaging shines the most. Everyone's terrified of bear markets. Crashes, corrections, recessions. People see the market falling and they think, I need to get out before it gets worse. But here's the reality. Bear markets are sales. Stocks are on discount. Everything you wanted to buy last year when prices were high, now it's cheaper. And if you're dollar-cost averaging, you're automatically buying more shares at those cheaper prices. Let's say you're investing $500 a month. When the market's high, you might be buying 10 shares. When the market drops 20%, suddenly you're buying 12 or 13 shares with that same $500. And when the market recovers, which it always has, those extra shares amplify your gains. This is how wealth is built. Not by timing the market, not by getting in and out at the perfect moments, but by staying in, by accumulating shares, by buying consistently through the ups and the downs. And when the market recovers, you benefit disproportionately. Because you bought when everyone else was too scared to. You bought the dip, not because you were trying to time it, but because your system forced you to. That's the difference between a systematic investor and an emotional investor. The systematic investor buys through the fear. The emotional investor runs from it. And 10 years later, the systematic investor is wealthy. The emotional investor is still trying to figure out when to get back in. Let me tell you about enhanced dollar-cost averaging. This is a twist on the traditional approach. Instead of investing the same amount every month, no matter what, you invest more when the market's down and less when the market's up. The idea is to take advantage of new information. Positive returns make stocks more expensive. Negative returns make them cheaper. Simulation studies show that enhanced dollar-cost averaging reliably outperforms traditional dollar-cost averaging. Why? Because it's buying more aggressively when things are on sale. It's leaning into the fear instead of ignoring it. But here's the catch. It requires discipline. It requires conviction. It requires you to put more money into the market when it feels the scariest. And most people can't do that. Most people freeze. They can't bring themselves to invest more when everything's falling apart. So while enhanced dollar-cost averaging might outperform on paper, traditional dollar-cost averaging wins on behavior. Because it's simple, it's automatic. It doesn't require you to make hard decisions in the moment. And here's the thing. Simple systems are the ones that last. Complicated systems fall apart because life is complicated. Markets are complicated, and the more variables you add, the more chances you have to screw it up. Dollar-cost averaging is one variable. Same amount, same schedule. That's it. You can't screw that up, and that's exactly why it works. Now let's talk about what this looks like in practice. And let's answer the question everyone's thinking. How much should I invest? Here's the honest answer. As much as you can afford without it hurting. If $500 a month feels comfortable, do $500. If you can only do $200, do $200. If you can do $1,000, do $1,000. The amount doesn't matter as much as the consistency. But here's what I'd suggest. Start with whatever you can comfortably do right now. Then, every time you get a raise, every time you pay off a debt, every time you cut an expense, increase that amount. Got a 3% raise? Increase your investment by 3%. Paid off your car? Take that car payment and redirect it to your investment account. Because here's the thing. Most people's expenses expand to match their income. You make more money. You spend more money. Your lifestyle inflates. And you never actually get ahead. But if you can just lock in those increases and redirect them to investing before you get used to having them, you'll build wealth without even feeling it. This is called lifestyle discipline. And it's the difference between people who make a lot of money and stay broke versus people who make less but actually build wealth. Now, you set up automatic transfers from your checking account to your brokerage account. Every month, on the same day, $500 moves over. Then you set up automatic purchases of an S&P 500 index fund. Every month, that $500 buys shares. No decisions, no inputs, it just runs, and you forget about it. You don't check your portfolio every day. You don't read the headlines. You don't obsess over whether today's the day to sell. You just let it compound, year after year, decade after decade. Because here's what most people don't understand. Wealth isn't built in days or months. It's built in decades. The people who get rich from investing aren't the ones who get lucky with one big trade. They're the ones who invest consistently for 30 or 40 years and never stop. Warren Buffett's net worth didn't come from timing the market. It came from staying in the market. For decades, through crashes, through recessions, through bear markets, he stayed in. And compound growth did the rest. You don't need to be Warren Buffett. You don't need to pick individual stocks. You don't need to be a genius. You just need to buy an index fund and hold it for a long time, through everything. And let the math work. 10% average annual returns. That's the historical average of the S&P 500. Some years it's up 30%. Some years it's down 20%. But over time, it averages out to about 10%. And 10%, compounded over decades, turns small amounts into large amounts. $500 a month at 10% for 30 years equals $1 million. $1,000 a month equals $2 million. $2,000 a month equals $4 million. The numbers scale, the math works. You just have to stay in the game. And the way you stay in the game is by not trying to be clever, by not reacting to every headline, by not panicking when things drop, by having a system that removes you from the equation. Let me address the elephant in the room. But what if I start investing today and the market crashes tomorrow? Great question. And here's the honest answer. It might. The market could absolutely crash tomorrow, or next week, or next month. Nobody knows. And that's exactly the point. If you wait for certainty, you'll wait forever. Because the market is never certain. There's always something to worry about. Always a reason to wait. Elections, inflation, war, recession fears, AI disruption, climate change. There's always something. And while you're waiting for the perfect moment, the market keeps going up. The S&P 500 has averaged about 10% a year for nearly a century. Through 2 world wars, through the Great Depression, through the dot-com crash, through the financial crisis, through COVID, it keeps going up. So yeah, maybe you start investing today and it drops 20% next month. You know what that means? Your second investment buys shares 20% cheaper, and your third investment buys even more if it stays low. And when it recovers, which it will, you've accumulated shares at discount prices. This is the whole point of dollar cost averaging. You're not trying to pick the bottom, you're spreading out your risk over time. So even if you start at the worst possible moment, you're still buying through the dip. You're still accumulating, you're still building. And in 10 years, it won't matter whether you started at the top or the bottom. What'll matter is that you started, and that you kept going. Because you are the problem, your emotions are the problem, your fear is the problem, your greed is the problem, your need to feel like you're doing something is the problem. The market doesn't care about your feelings. It doesn't care if you're scared or confident. It doesn't care if you think it's going to crash tomorrow or rally for the next 5 years. It's going to do what it does. And over the long term, what it does is go up. But only if you're in it. Only if you stay invested. Only if you don't bail out when things get hard. And that's the real test. Not whether you can pick the right stock or time the bottom, but whether you can sit there and do nothing when everything feels like it's falling apart. Whether you can keep investing when your brain is screaming at you to stop. Most people can't. And that's why most people underperform. Because they let their emotions drive their decisions. And emotions are terrible investors. So here's my challenge to you. Stop trying to be smart. Stop trying to time the market. Stop checking your portfolio every day. Stop reading the headlines and making decisions based on fear or greed. Set up a system, automate it, and walk away. Let it run for 10 years, 20 years, 30 years, and watch what happens. Because I promise you, the people who get rich from investing aren't the ones who were the smartest or the luckiest. They're the ones who were the most boring. The ones who just kept buying, month after month, year after year, through crashes and rallies and everything in between. They didn't try to time it. They didn't try to beat it. They just participated. Consistently, systematically, automatically. And that's how you win. Not by being clever, but by being disciplined. Not by reacting, but by staying the course. Not by guessing, but by trusting the process. So yeah, if you want to outperform in uncertain times, the answer isn't to get smarter. It's to get more boring. Set it. Forget it. And let compound growth do what it does best. Because the market rewards the patient, not the clever. And if you can just be patient enough to stay in the game, you'll beat most of the people trying to outsmart it. Now, before I go, let me say this. I know this isn't sexy. I know it's not exciting. I know it doesn't make for good cocktail party conversation. Nobody wants to hear about how you're just buying index funds every month and doing nothing else. But you know what is sexy? Having $1 million in your retirement account. Being financially independent. Not having to worry about money. That's sexy, and that's what boring, systematic investing gets you. So if you want to join the club, the one where people actually build wealth instead of just talking about it, start automating your investments. Today. Not tomorrow. Not when the market feels right. Today. Because the best time to start was 10 years ago. The second best time is right now. And every day you wait is another day of compound growth you're leaving on the table. And hey, if this made sense to you, if you're finally realizing that boring beats clever, then maybe you should subscribe. Because the people who subscribe, they're the ones who actually take action. They're the ones who build wealth. So join them, hit that button, and let's keep this going. Because at the end of the day, it's not about being the smartest investor. It's about being the one who's still here 20 years from now. And the only way to guarantee that is to have a system that keeps you in the game, no matter what.